Chirag, thanks so much for joining us, and it's really nice to be having you on the show today.
Thanks, Ajay. Thank you
So
for having me
Chirag,
on.
I'd like to start our conversation today. Great to see you. Taking the clock back a bit, around October, when the correction actually started setting into the Indian markets after two and a half very good years. And after that, one after the other, the headwinds started hitting, and we went into a 10, 11-month corrective phase, be it war, the inflation worries, and all of that, valuations. How are you analyzing things right now as we see them, especially all the factors which led us into a corrective phase? Do you see some normalization happen? How are you looking at those 4 or 5 big factors?
Sure. So let me start off by pointing out that valuations, which had become quite expensive, have now normalized. So whether you look at it at the Nifty or you look at the small cap index, P multiples have now come back to long-term 10-year averages. And in that sense, it's an environment to be a lot more constructive on equities, that valuations are now sensible. Having said that, clearly there are some challenges out there in terms of inflation and related to that, interest rates. And I think there has been some respite on that. We've seen a sharp correction in commodity prices. From the top commodity prices, both agri and non-agri are off 30-35%. So to that extent, I think there is a little bit of breathing room that has been created. At the same time, we are seeing now some signs of a slowdown in demand. This is more true outside of India than within India. And that should also bring some further pressure on commodity prices. So I think the fact that commodity prices are coming down is certainly good news. I think the fact that demand is moderating in the US and other geographies is also good news. And we tend to be quite myopic in the way in which we look at markets. And everybody's focused today on rising inflation and interest rates, but we forget that there is an expectation that by the second half of next year, interest rates would have peaked out and can possibly come down.
Fair point. In fact, people are again talking about QE, a fresh round of QE in the second half of the year if slowdown actually accelerates. We'll talk about macros in a bit, but sure. Coming back to the point, because you navigate small cap and mid cap end of the market for such a long time, yes, valuations may have got eased, but a lot of earnings have also been scaled back. Do you think that adjustment is over now? Valuations right now are capturing in a bit of a slowdown on earnings as well, and margin pressure, all of that, or that adjustment is still yet to happen?
No, I think earnings expectations over the next 2 years are quite reasonable. So you look at it for the Nifty as an example, CAGR of 15% over the next 2 years, I think is certainly achievable. Now, to fine tune that and to figure out whether we'll get it right in the short term or not, I think is a little bit harder. But I think over a 2-year period, a 15% CAGR is not a tall order for an economy which is also growing at sort of 12-13% in nominal terms. So we may have a miss or two in any particular quarter, but when you look at it from a 2-year perspective, I think earnings expectations are reasonable.
Chirag, can you share with us the mid-cap opportunity fund or even the small cap fund, for example? How is the earnings trajectory looking of this portfolio next 2 to 3 years on a blended basis?
Sure. So a lot depends on which stocks you pick and choose. But when you look at our portfolio in aggregate, we have earnings expectations of about 20-odd% CAGR for the next couple of years. And I think that is something which is achievable. We've seen a big shift in demand away from the unorganized sector towards organized companies. And this benefit is really coming significantly to small caps and mid caps. That demand doesn't shift automatically to large caps. It actually shifts away from mom and pop shops, away from the unorganized sector to small and mid cap companies. So we're seeing a good traction from that standpoint. So I think Nifty, 13 to 15% kind of earnings growth. And for small caps, if you pick a sensible portfolio, you can still manage to get earnings growth, which is a little bit higher than that.
Great. And what kind of valuation compression has happened or correction has happened in the last 11 months from, the peak valuation? How much have they come down?
So I think everybody's aware of the fact that, the small cap index is down 20%, mid cap 15, and so on. So those, people are well aware of that. But I think what we forget is that within a 20% correction in the small cap index, there are plenty of stocks which have corrected far more than that. So more than 30-35% of the index would have corrected by 30-40%. So in this fall of index falling by 20%, we've seen a lot of individual stocks correct very, very substantially. And that is offering a lot of opportunity, because it's not that the companies which have fallen have necessarily seen their earnings fall commensurately. So prices are down 30-40% in many cases, while earnings may be either similar to what they were in the past, expectations that is, or slightly below. So I think in that sense, there is a lot to pick and choose.
Sure. Chirag, you briefly spoke about the point that inflation appears to be peaking out and rates will also start going lower maybe in the second half of the next year. When you speak with some of the portfolio companies in the mid and small cap side of your portfolio, what is the sense are you getting? How are they gauging the demand environment? Are there any worries, or they are navigating it pretty okay?
I think companies are by and large reasonably comfortable on that demand environment. We are seeing agri demand picking up a little bit in pockets, and that's a good sign. And the fact that we've had a good monsoon so far is good news. We are seeing a reasonable traction on the investment front. We are seeing government continue to spend on infrastructure. I think there are good prospects for housing to improve over a period of time. Affordability has certainly improved. House prices are flat for many years. And as a result, we could see a pickup in housing. And if and when housing picks up, it creates a lot of further downstream demand. So I think overall the demand environment is reasonably positive and companies are reasonably optimistic. Let us not forget that companies have handled the COVID environment quite well. So the last couple of years, earnings growth has been quite substantial. Cash flows have been reasonable. Balance sheets have been delevered. And in that sense, the body language and the positivity is there at companies. I think the concern that they have is the unpredictability of raw material prices. And when variables like the chief raw materials fall by 30-40% or move by 30-40% plus and minus, I think that creates uncertainty. So I'm hoping that we'll see some stability in commodity prices. But other than that, I think companies are quite confident.
In fact, let's take that point of Capex and demand a little further, because I was just analyzing your portfolios. We see a lot of mid-tier engineering and quasi plays, basically Capex companies which actually participate in with other larger Capex engineering companies. Do you really see a nice Capex cycle, durable Capex cycle kicking off now from here on?
Sure. I think, when you look at Capex, there are three parts to Capex. There's government Capex, which is predominantly in infrastructure, and that looks quite robust. There is corporate Capex, which has been underinvested in for the last couple of years, and I think there is a reasonable expectation of that picking up. And then there is, of course, household Capex, which goes into real estate. And as I mentioned, that affordability of real estate and with the advent of RERA, prospects for real estate also look quite good. So in that sense, the outlook for Capex is quite positive. And I think the advantage of owning the smaller businesses, the ancillaries, the industrial ancillaries, is they tend to be less cyclical. So they have a component of exports, they have a component of domestic market. Within the domestic market, they're quite well spread out, consumables as well as sort of capital good kind of business. So in that sense, I find that the cyclicality in some of the smaller industrials tends to be less than in the larger industrials, where they are in some cases dependent on large orders.
Fair point. What are your thoughts on the chemical space? We saw a fairly good run a couple of years back in the entire chemical space, both agri-chemicals as well as specialty chemicals because of China plus one. And then they went through a very, I would say, brutal correction, some of them coming down 40-50% as well because of logistics issues, raw materials. Do you think that is getting normalized now, and the structural argument in chemicals, Indian chemical space, is as strong as earlier? How are you analyzing that?
I think there is a strong argument for chemical companies. And as you pointed out, this China plus one story is playing out, and these companies have sort of very strong manufacturing and management capabilities. But valuations, while they have corrected 30-40%, let us not forget where this journey has started, right? And companies have moved up by 3x, 5x, 10x over a period of time. And even when you look at P multiples today, P multiples trade at a premium to 3-year, 5-year, 7-year averages. So yes, these are businesses businesses which are doing well. They have long-term prospects, great long-term prospects, but valuations are a little bit on the expensive side. So I would be in, I think some of it is justified, right? Because the outlook is quite positive. So some premium to historical valuations can be justified. But I think one should still be a little bit careful and pick and choose individual businesses depending on their merit. So I don't think this is a uniform sort of advocation of the chemical space because chemicals are a little bit expensive. But I think if you pick and choose businesses which have good prospects, one can do reasonably well.
Chirag, which end of the spectrum do you like in auto ancillary? That's also a cyclical, a cyclical sector which is coming back after a long while. The ones which focus on OEM, the domestic ones, or some of them who have export opportunity?
So actually, we like a good mix, right? We want companies which have both an OEM as well as an aftermarket mix, and because that gives some stability to the business. We also want companies, ideally, which have a domestic and export mix, because once again, these tend quite often not to move in tandem, and that gives more stability to the business. So we want a reasonable mix of all of these, and I think this is the big advantage of auto ancillaries. They are spread across OEMs and aftermarket. They are spread across domestic and export. They also spread across whether it is two-wheelers, commercial vehicles, passenger vehicles, and so on. So in that sense, like you pointed out earlier in the industrial ancillaries business, the auto ancillaries are also extremely sort of resilient and have demonstrated over a period of time much less cyclicality than OEMs. So in that sense, I think auto ancillaries, you have to pick high quality businesses, high quality managements. But I think those stand to deliver quite well over a period of time. I think India is gaining in general in recognition from a manufacturing standpoint. And I think auto is clearly one area where you are seeing that.
Chirag, how are you playing defense space in your portfolios? Because there is an import substitution angle and then there is an export opportunity. And many of them are reasonably new company which got represented in last 1 or 2 years. You have a big play there?
So we have a fair exposure to the defense space. So defense has both the public sector undertakings as well as sort of the new private sector companies. And what we are seeing is order books are robust. So order book is anywhere from 3, 4, 5, 6 times revenue. So in that sense, there is a lot of visibility from a revenue standpoint going forward for the next couple of years. And I think that is good news. But valuations are starting to change. So there was a time when a lot of these businesses would trade at sort of low double-digit multiples, and that is now changing, and valuations are moving up. It's not across the board, but it's certainly moving up. And this is probably even more so on the private sector side, where valuations have certainly moved up. So I think you have to be a little bit careful because there can be hiccups along the way. But our preference is, or my preference is more for some of the public sector undertakings. I think they have a lot of visibility from a revenue standpoint. Their valuations are also quite sensible. And in that sense, I think attractively placed.
Mm-hmm. Talking of exports, Chirag, we are also looking at some of the apparel exports from India also going up. Of course, they got hit because of cotton prices went up, but they've come down. Do you like that end of the textile space, or do you like branded retailers which are catering to the domestic demand?
The branded retailers are quite expensive, right? So I think it takes quite a bit of courage to own those businesses at these valuations. So we've at least avoided those. Our focus in our funds is to avoid businesses which are sort of extremely expensive, despite the fact that they may be extremely high quality. So I would say that possibly you would find us more interested in some of the garment companies. There, the valuations are a lot more sensible.
Sure. And real estate, you briefly spoke about. Are you directly having some of the property developers in your portfolio, or do you like the entire housing finance mid-cap companies or even cement? How do you play that real estate sector revival in your portfolios?
So I think that's the interesting thing about real estate. You don't have to play it directly through a real estate company. There are a lot of ancillaries which go into it. So you can, I mean, one choice is to buy a real estate company, but you can also buy into a plywood company. You can also buy into a cement company. You can buy into a finance company. So I think you have to pick and choose because, I think valuations are important to keep in mind. But having said that, I think some of the mid caps which play into the real estate story, I think those are quite well positioned, and we own those in our portfolio.
Right. A bit before we wind up, but a bit of view on macros. I mean, you said that the signs are clear that probably inflation seem to be peaking out. Do you see in the next 6 to 8 months market normalize this, because the valuation got compressed a whole lot because of interest rate rising, trajectory, inflation coming in there, hitting the margins of corporate India. If this normalizes, then the valuation argument will completely change on the upside. Do you see that play out over the next 6 to 12 months, additionally, apart from earnings?
I think we have to keep in mind that we are in general in an environment where there is going to be quantitative tightening. And while that may ease somewhat towards the second half of next year, valuations have normalized and valuations are reasonable today. So I think from an investor standpoint, we are not in an environment where valuations are expensive and hence returns could be compromised. But at the same time, we're not in an environment where valuations are cheap and hence returns are going to be outsized. Valuations are close to historical averages, which means that one should have reasonable expectations of returns going forward. There are a lot of uncertainties out there. And while interest rates and inflation may have sort of peaked out or may peak out sometime in the next sort of 6-9 months, there is a lot of uncertainty still on the demand front. And it's difficult at this point to gauge how much will demand compress. I think India is relatively better positioned. But what is happening outside of India, in the US and Europe, etc., I think it's still very difficult for us to gauge how much will demand compress. So I don't think we are out of the woods from a risk standpoint. But I think valuations have certainly moderated to levels where one can have a reasonable return expectation.
All right, Chirag, we'll let you go on that one. Thanks so much for joining us. I really appreciate your taking out time and chatting with us.
Thank you, Ajay.
All right.